In the last video, we talked about that raising investment means giving away a percentage of your company, and we looked at some of the different ways that that can be structured. And in this video, we're going to talk about some of the other things to think about in practice when raising investment. So one of the key things is going to be valuation. So how much of your company are you giving away for how much money? And valuation can be more of an art than a science. So there's a number of different ways that you can value a company. But at an early stage company, investors tend to look at the past performance of the company versus future potential of the business. And for founders, what you want to think about is firstly not setting your valuation too low, because that means you're giving away too much of your company early on. And then you have to think about sort of future funding rounds and take that into account when setting your valuation. And then also you don't want to set your valuation too high, because if you set your valuation too high and then you're not able to justify that valuation or keep that valuation, you might have what's known as a down round. And that can be difficult from a sort of public perspective, because it looks like you're sort of devaluing your company. But also, if it's at a stage where you have an institutional investor on board, they sometimes have what's known as an anti-dilution protection. And that means that if there was a down round, they're not diluted as much. And that means the other shareholders and you as founders are diluted more than them.
Yeah, so that's something to think about when you're at institutional investor level. At this stage, probably the more key thing to think about is just that your valuation isn't a balance sheet valuation. This isn't a valuation that you've gone to an accountant to get based on the assets and the income of the company and any property that you own. This is a valuation that's based on future potential. The investors are investing in you, the team, the tech, any traction that you've had so far. So it's a kind of valuation based on future potential, which is why it's more of an art than it is a science. The other thing to think about at this stage is how much money you need to raise, because you want to raise enough that you've got 12 to 18 month runway and to be able to fulfill the things that you're saying to your investors that you're going to use the money for. But you don't want to raise so much, you don't want to raise money you don't need to raise, because remember that every time that you're raising money, you're giving equity away sort of as a quid pro quo. So if you raise too much, you're giving equity away too early, which links back to valuation. The other thing to remember is that once you've given equity away, someone has become a shareholder, so they own the shares in the company, and you can't just take them back. That once they're an owner, it's theirs, and they have to follow a mechanism in the articles and things, but you can't just take those shares back.
Yeah, and that's an important thing to think about, because it means that you're now accountable for other people, because there are other owners in your business, and that could mean that you have to keep them informed as to what's going on about the progress of the company. So whether that's providing them with financial information or a report against key performance indicators, or it could mean that you have to involve them in certain decision making. So that could mean at a shareholder level, you have what's known as investor consent matters. So that's a list of matters that you've agreed that you would have to go to them for consent if you wanted to do. So that's going to be things like if you wanted to issue further shares in the company, or if you wanted to change the company's articles, or it could mean you've agreed that if you want to increase your salary over a certain amount, that you have to go to them for approval for that. Or it could we could be talking about decisions at a board level. So if you've agreed that the investors are entitled to have a director on the board, it means that they're entitled to attend all board meetings, they're entitled to vote on board decisions. So when you've gone through an investment round and you've got this outside investment, it means corporate governance becomes more important, and doing things in the right way becomes more important. So it's the right people making the right decisions.
Yeah, so basically just in practice things get serious. You have external people now involved that you're accountable to. It's not just you and your co-founder anymore. So you need to make the right decisions in the right way and in a consistent way, in a more structured and consistent way.
But that doesn't mean that taking money is a bad idea, because investors can bring other benefits than just their money. That could be the expertise that they have in maybe the sector your business is in, or just expertise generally in, say, finance or accounting. Or it could mean that you have access to their kind of network of contacts that are going to help you grow the business in the future.
Yeah. So when you look at an investor, obviously think about, their capital position and whether they can invest in you and then follow on, but also think about what other skills do they have, what network do they have, and also can you work with them in the future going forward, because these are going to be part of your business. I think that's it for this one. We're going to now, in our next video, we're going to look at what are the key investment documents that you're likely to see as a founder.